If you want to get into real estate investing, one of the first questions you must answer is, should you become an active or a passive investor? As a busy doctor with a family, I didn't want to deal with tenant headaches at all hours of the night. So for me, the choice was easy. I chose the passive route. If you choose to become a passive investor as well, your options typically involve either a real estate syndication or a REIT. In this video, we're going to break down each one, the pros, the cons, and then decide which one is the better option for you. If you're new here, hi, I'm Dr. Jeff Anzalone, a periodontist helping you exit the rat race so you'll achieve financial independence in 7 years or less. I have a free guide on building passive income that you can get with the link below this video. Let's get started by first defining exactly what is a REIT. A REIT is also known as a real estate investment trust. When you invest in a REIT, you're actually buying stock in a company that owns income producing real estate. REITs can either be public REITs or they can be private REITs. Now, if they're traded publicly, this means that their shares can be bought and sold on major stock exchanges by anyone that has a brokerage account. On the other hand, private REITs means that they're only available to accredited investors who meet certain income and net worth requirements. Some examples of REITs are hotels, retail centers, data centers, self-storage, office buildings, shopping malls, and apartment buildings. Investors can purchase these shares via the stock market, either through the purchase of individual company stock, mutual fund, or exchange traded funds. Occasionally, people think that investing in an apartment REIT is similar to directly investing in an apartment building or a typical real estate syndication, but they're not. Let's take a look at the differences. So let's next define what exactly is a syndication. A syndication is a way that a multiple group of investors are able to pool their funds together to purchase an existing property or build a new one. Syndications are actually governed by the SEC, or Securities and Exchange Commission, and must file documentation, which is called a private placement memorandum, with them. Originally, these types of investment property were exclusive to the very wealthy, but now are much more accessible to you, the accredited investor. So who exactly is involved in a real estate syndication? There's typically two groups. The first one is called a general partner. These are also called the sponsor or the syndicators. And typically what they do is they find the property, they underwrite the property, they perform the inspections, they run the numbers, they arrange the financing, they basically manage the asset. They pretty much do everything. They run the show. The second type of person is called a limited partner or an LP. These are the passive investors. These are you and me that have limited risk. The passive investors, they offer up their capital in return for a share of the cash flow and profits from the property. So limited partners are not actively involved in managing the property, which makes it nice. We can go to our 9-to-5 job, sit back, relax, and collect the distributions, also called mailbox money. Typically, these distributions start during the hold period about 6 months after the property closes. Now let's take a look at the ownership structure. Now, we're going to talk about the differences between specifically the REITs and the syndications. So when we talk about the ownership structure, remember that when investing in a REIT, you're purchasing shares in the company that owns the real estate assets. You don't actively own the company. Now, when you invest in a syndication, you're able to invest directly into a specific property. Usually you'll own a certain percentage through an entity, and this entity is usually a limited liability company. And this LLC actually holds the asset. The next difference is the number of properties. Now, an investment in a REIT portfolio would give you access to several properties across multiple markets in an asset class, which also could mean for greater diversification. If one or two properties are underperforming, some of the others within the REIT can actually help offset the loss. This is similar to investing in a mutual fund versus investing in a single stock. In a mutual fund, if a handful of stocks go down in value, there's typically hundreds of others that are available to help balance out the returns. On the flip side, with real estate syndications, you're actually investing in a single property typically in one market. Now, with these, you know the exact location, you know the number of units, you know the financials specific to that particular property, and you know the business plan for that investment as well. By knowing exactly where your money is going, you can perform your own due diligence on that asset, on the market location, on the tenants, the leases, to ensure that they're comfortable with every aspect of the transaction. Now let's move on to how to invest in both of these. Because most REITs are listed on the major stock exchanges, they're able to be easily found and invested directly, again, stock market through mutual funds, ETFs. On the other hand, syndications are often under a SEC regulation that disallows public advertising, which actually sometimes makes these harder to find than REITs without actually knowing the sponsors. So a lot of times you need to figure out and you need to find the specific sponsors or the general partners that are running these syndications. An additional existing hurdle is that many syndications, again, are only open to accredited investors. Even once you've actually obtained a connection with these syndicators, you've become accredited and you found a deal, you should also allow for adequate time to review the investment opportunity. Then you'll have to sign all the documents that come along with it. Then you have to actually go and wire in your funds. Typically, again, quarterly distributions will start 6 months after the property closes. Overall, the fees with syndication are often much less and increasingly more transparent than whenever you invest in a REIT. Now let's talk about the liquidity in both of these. One of the main reasons people actually invest in REITs versus syndications has to do with the liquidity. REITs are much more liquid than a syndication, and you can actually buy or sell shares of a REIT at any time. Syndications, however, are accompanied by actually they come with a business plan that often defines holding the asset for a certain amount of time. Typically, most of these are kind of a 5 to 7 year. Sometimes you can find some that are 3 to 4 years, sometimes longer, up to 10 years. Just depends on the actual deal and the syndicator. And during this time, your money is actually going to be locked in. Now let's move on to the actual investment minimums. Real estate syndications typically require a higher minimum, and these can vary anywhere from 50,000 to 100,000. Most of the ones that I'm currently investing in are about the 75,000 range. When you invest in a REIT, you're actually purchasing shares on the public exchange, some of which can just be for a few $100. Thus, the monetary barrier to entry is low, which can actually make it more appealing to new investors. Even though you'll need more capital, again, to invest in syndications, the returns and the tax benefits are usually higher. Speaking of returns, let's talk about the returns of both of them. So, while returns for any real estate investment can actually vary wildly, the historical data over the last 40 to 50 years reflects actually an average of 12.87% per year total return for an exchange traded U.S. equity REIT. By comparison, stocks average 11.64% per year over that same period. This means on average that if you were to have invested $100,000 in a REIT, you could expect somewhere around $12,870 a year in dividends, which of course is a great ROI. Syndications, however, between the cash flow that you'll get again every quarter and the profits from whenever the asset sells after the hold period, these typically can average around 20% a year once you look at both of those. As an example, a $100,000 investment in a syndication with a 5 year hold period and a 20% average return, it may make, over a 5 year period, it could make up to $100,000. Now, again, this takes into account the cash flow and the profits from the sale, which actually means that in this scenario, your investment would have doubled. It would have been a 2x equity multiple over the course of those 5 years. Let's move on to now the last one, and that is tax benefits. And one of the biggest benefits of investing in REITs versus syndications has to do with taxes. When you invest directly in a property, real estate syndications included, you receive a variety of tax deductions. And one of the most beneficial one has to do with something called depreciation, which is the writing off the value of an asset over time. Sometimes this tax benefit is a big enough reason for investors to invest in real estate in the first place, myself included. Oftentimes, the depreciation benefits actually surpasses the cash flow of the asset. So you may actually show a loss on paper, but you can also have positive cash flow. Now, those paper losses can actually offset some of your other income, like that from an employer. When you invest in a REIT, because you're investing in the company and not directly in the property, you do get some of the depreciation benefits, but those are actually factored in prior to the dividend payouts. However, when you invest in REITs, again, since you're not investing directly in a property, as you can imagine, the tax benefits aren't as great versus investing directly into a syndication. While you still receive the benefits of depreciation in a REIT, which is taken out before you receive any dividends, you can't use any of that depreciation to offset any of your other income like you can with the syndication. Unfortunately, dividends are taxed at your ordinary income level, which can contribute to a much larger rather than a smaller tax bill. All right, let's get down to it. Which should you invest in, syndication or REIT? Now, for those individuals seeking passive income from a real estate investment, again, the two main options are REITs and syndications. While the goal of each option is the same, to earn a return, they both have similarities and fundamental differences between both of them. Investors should focus on their characteristics and choose the one that is most suitable to their particular situation and to their particular need. For the high income professional that has a large tax bill, the more the legal tax deductions available, the better. If you only have, let's say, $1,000 to invest and you want access to that money freely, then typically REIT is going to be your best choice. If you have more capital available and you want direct ownership plus greater tax benefits, then a syndication may be a better fit for you. And remember, it doesn't have to be one or the other. You can begin with investing in REITs and then you can add syndications later. Or you might initially try to do both just to try to diversify. Either way, investing in real estate, whether directly or indirectly, is going to be forward progress more than likely than what you're doing now. Now, I mentioned earlier that one of the major benefits to investing in syndications has to do with a tax benefit called depreciation. What you can do now is check out this next video where I'll take a deep dive to see how you can save massive amounts of money on your taxes. I'll see you in the next video.